Hello there, I'm Mitch Goldberg. You're watching Be the Boss of Your Money. This is my live stream where we talk about everyday personal finance, investing tips, business strategy, and so many other topics that fall underneath those umbrellas. The idea is for you to become the boss of your money, not your money to become the boss of you. Are bank stocks and energy stocks poised to be the leaders in 2021? The year is still early. Investors, including yourself, may be asking, where should I put my money? What stock should I buy? Where do you see value, especially in a world where it seems like it's very hard to actually find value? So let's roll the intro. We're going to talk about value, and we're going to talk about financials and energy and why they may have some upside and why they may be worth taking a second look, especially since these stocks were basically, these sectors were the least loved of 2020. So let's roll the quick intro. As we do every day, stick around. This is going to be good. Hello, I'm Mitch Goldberg, your host. Let's fix the mic. Thank you so much for joining me. I greatly appreciate your time. It's very valuable, and I appreciate that you are spending some of it with me. We're talking about bank stocks, energy stocks. What we're really talking about is looking for pockets of value that offer both upside potential, maybe not too much downside, because we are in a market where literally nothing is cheap. I shouldn't say nothing, but you've seen the market go up. We've hit so many new records. It's been a strong market. Dow crossed above 31,000, NASDAQ over 13,000, S&P 500 is not too far from hitting 4,000 for the first time. So we want to find some pockets of value. So what I want to do is just give you a quick update on the market, how things did today. And then more importantly, we're going to get into energy stocks, financials, and see if there really are pockets of value. And I'm going to show you a couple of ways where, a couple of things that you could take a look at for yourself. But my conclusion, just to get this over with, is that I do see value from financials and energy in a market where I don't see a lot of value elsewhere. I do see a lot of growth opportunities, and there's a lot of great growth and a lot of companies that are surging. But if you're buying a great growth story, odds are that growth story was a great growth story 6 months ago, a year ago, and you're sitting on it. You're at least you're seeing a stock, if you're not in it already, that's up a lot. And you may be looking for a place to put some money into, to put some money to work, and you may be looking to take money out of sectors that have, or individual stocks that have gone up a lot, but you want to keep the momentum rolling. You want to reinvest, keep compounding. So we need places to look at. This particular episode, I think, is very specific to those who are more or less risk averse, more risk accepting. So let's take a look at a couple of things. Okay, let's do the quick share screen. I'd like to welcome all of you. If you have any questions, hit me up in the comments, please. If you have any words of wisdom that you'd like to share with the rest of us, I would love to hear that. That's always something that we would love to see. We have a few people out there. Peter's out there. Thank you, buddy. Hey, Mitch. Peter coming from Facebook. Gary. Hey, Gary. How are you? Hope you had a great New Year. And it's good to see you. We're all back to work. And I said to somebody, 2021 is starting to feel a little 2020-ish, isn't it? I saw a meme. It said, I am so upset with the news right now that I've decided to watch a documentary about Ted Bundy. You can't make this stuff up. I don't know. Should I laugh? Should I not? I'm sorry, but I guess I have to laugh, right? Let's do a quick share screen. We'll talk about the day's action and hey, hold on a second. Stop the press. Phil is out there coming at us from Facebook. Thank you so much. Great to see you. Really appreciate you joining us. So got a couple of friends out there. The pressure's on. I feel like I have to deliver now. So let's take a quick look at what's going on today. We'll talk about value, but real quick, you see, not a horrendous day. I mean, based on what we expected before the market opened at about 8:30 this morning, futures were down over 250 points in the Dow, and it looked like we were having like if you recall, last Monday, we also had a pretty big down day. Not that today's a big down day. Today was more or less a non-event as far as days go. Just a little bit of profit taking. We had a solid start to the first of the year, to the first week of the year. By the way, as indicators go, as goes the first week, as goes the year. So for historical indicators, that is a very big indicator according to the things like Stock Traders Almanac. So we had a good first week. We should have a good year. That certainly did work for last year. So we'll see how it works for this year. So I see you out there. I will hit you on that. We're going to talk about oil and gas. So that's like one of today's main topics, Gary, and definitely have my views on that. More on oil than the natural gas, but we'll get into that. All right. So let's take a look. Let's move on down the line. Let's take a look at this. Now we're going to get into the heart of the matter. You see today, energy was the best performing sector of the day. I'm going to make this a little bigger so you guys could see it on your smartphones, okay? This is XLE that we're looking at. This is the big energy ETF. It's a very widely followed, widely traded ETF that tracks the energy sector, okay? The Spiders ETF for energy. And you see this where you see between 22.88 and $60.02. That's the 52-week high and low. It's more or less in the middle, and it's really has a lot of red, but it's coming from the left side, moving to the right side. So just keep that in mind. We're going to get back to that, and I want to look at financials. All right, so here's the XLF. This is the financial sector. Okay, that's the big ETF that represents the financials, the Spiders ETF sector fund, select sector. That has gone from a 52-week low of 17 and change to 31. And that's had a pretty big move as of late, and that is tied directly to the move of the U.S. 10-year Treasury going above 1%. So think of it this way with financials. The cost of their capital is what they pay you in your bank account, checking account, savings account. They're paying you 0.01%. And then they lend the money at longer term borrowing rates that are often tied to the 10-year Treasury, such as mortgage debt, commercial mortgage debt, a lot of loans. The 10-year Treasury is the most important yield. The yield of the 10-year Treasury is the most important thing to follow as far as bonds go, because so many loans are tied to the 10-year Treasury. So if the 10-year Treasury was paying like 0.38%, which was about the all-time low, banks had very little money to make. They would pay you 0.01%, and they would maybe make loans at 0.3, 0.4%. But now that they're still only paying you 0.01%, for example, and they could now make loans closer to 1%, that's a pretty big spread. And that means their net interest margins are much higher, and they start to make a lot more money, which is why you have seen two stocks like Bank of America and Wells Fargo, which were just chronically in the low to mid 20s, all of a sudden break out. And now they're into the low 30s. JP Morgan kept hitting it about 120, back to 105, and now it's broken out a lot higher than that. So that's how banks work. And then energy stocks, we actually saw a few months ago, more than a few months ago, about 6 months, 7 months ago, the cost of the price of energy went zero for it was a very brief amount of time. And people thought that's it for the energy complex. But as the price of oil goes up and there's so much capacity, so much excess oil, mostly because the economy got so weak that the demand for oil and gasoline plunged because of over drilling, especially with we're in a fight between the shale drillers domestically, Saudi Arabia, Russia. So there's just a battle for market share. But now that the economy is coming back and a lot of producers have failed, we've we've probably seen more producers in energy fail in the last year than ever in history. We have. So that means that the stronger producers have survived. They've managed to clean up their balance sheets. They've managed to make more with less. And now that energy is coming back, you have to take a look at the low P/E ratios of a lot of the energy stocks, like a Chevron, for example, and you have to take a look at the dividends that these companies are paying. And you've got yourself what appears to be not just down and out stocks, a down and out sector of value play. You have a catalyst in the form of rising earnings now because of the rising price of oil. Let's take that to the financials. The financials have learned to cut costs. They have either made money on, wealth management. Like Bank of America owns Merrill Lynch, Wells Fargo owns Wells Fargo Advisors, et cetera. So the wealth management business has helped keep these companies afloat. Investment banking, we've had more IPOs, I think a record amount of IPOs this year, or at least the most since the bubble, the tech wreck. But the IPOs are a lot bigger. So investment banking is doing extremely well. But now you have trillions of dollars in savings accounts and checking accounts, money markets. Now the banks could make real money on this stuff because the yield curve is steepened. The spread between short-term rates that banks have to pay you and long-term rates that they get paid on has widened. So if you ask me, where are the pockets of value? I'm thinking it's energy and financials. There's different risks. The reason I showed you those red lines and green line before, where energy is like in the middle of its 52-week range and financials are at the top, at the high end of their 52-week range. I think people still have a lack of trust for the for say someone's out there. Sorry, I'm skipping around. James is out there. Hi, Mitch. New mic sounds really good. Thank you, James. And just so everybody knows, James right now is, well, not just right now, always, because he lives there. He's in Melbourne, Australia. So my new mic, this is a new mic, and it sounds so good that James right now says it sounds good in Australia. So thank you very much, James. I really appreciate the feedback. James is also a fellow live streamer and financial advisor. He's in Australia. He creates wonderful, amazing content. Good friend as well. We've become friends through LinkedIn, and we've even met on video on a live stream. So follow James on LinkedIn. Okay. So the financials have had a very quick rebound lately because longer term rates have gone up. Now, you might think, well, what about the recession and the economy is not so strong? Banks have benefited greatly from stimulus as well, and it's kept a lot of companies afloat. The Federal Reserve has bought bonds directly from corporations to keep them afloat. So I would say banks happen to be in a very good position. The Federal Reserve has said repeatedly that they are not only going to keep interest rates at rock bottom lows, but they'll even let inflation rise above their targeted rate of 2% inflation. I don't know how they're going to do that. My concern is if inflation really gets out of hand, the Fed might have to move because the bond market, the bond vigilantes will force the Fed, will force it to move. Having said that, you could take a look at stocks like Zoom, which is off substantially. That's like Zoom video is the quintessential pandemic work from home, stay at home stock. And if you see how that has done, and you take a look at the FANG stocks, these have all basically peaked last September and October, and they're holding their own, but with a general trend downward. That's part of that rotation out of the work from home, stay at home stocks into the economically sensitive stocks. But having said that, I think financials and energy, out of the 11 major sectors of the U.S. economy, in my opinion, look to be the cheapest or the best value plays in the market, not just because they're down, but because both of those sectors have one of the most clear catalysts for higher earnings. If you have any questions, hit me up now because we are almost ready to end the live stream. Okay. You could hit me up in the comments of the replay. I'll definitely see those. I always keep an eye out for those for a few days. Thank you very much for joining me. I've got a couple of changes, a few things I'm excited about for Be the Boss of Your Money. We're going to change the format a little bit where it's tough to say I'm going to do this every, let's say Monday, Tuesday, Wednesday, Thursday, but we're going to focus on innovative sectors such as 3D printing, biotech. We're going to do sector spotlight. One sector I want to cover is the physical fitness sector. Okay, the health clubs that are publicly traded, personal finance. I'm going to have more guests, investment strategy and tips, and business strategy. Like, for example, a C corp versus an S corp. What's better for you? Those kinds of questions. So I look forward to bringing you a lot more great content. I said great content. That's right. Thank you very much, and I'll see you tomorrow.